welcome to the deep dive. Ever wondered how uh, really savvy business owners move assets around,
Hmm.
inside their companies or plan for the future and somehow don't get hammered by taxes?
Right.
Well, today we're diving into exactly that, specifically the strategic use of trusts,
hmm
exploring how they can be, well, a really powerful tool for potentially tax-free asset transfers, maybe between divisions, maybe for the long term.
Yeah, we've looked at some material that really unpacks this. It shows how owners can get more control and potentially save quite a bit of money.
Sounds good.
It really is. Think of this as a way to get a handle on a pretty sophisticated financial strategy.
Yeah.
Our sources show how these trusts, if they're structured correctly, offer, real advantages for managing and transferring business assets. It gives you an edge, financially speaking.
So the goal today is to demystify this a bit, make
Yeah.
it clear, show the practical side.
Exactly. Show you the power they can actually hold for your business.
Okay, so let's start at the beginning, high level. What is a trust, really, in this business context? It sounds formal, but what does it do?
Basically, a trust is just a legal vehicle. It lets a business owner entrust their assets to someone else,
Okay.
who then manages those assets for the benefit of a third party.
So it's like setting up a secure holding system with specific rules.
Precisely. A secure system governed by instructions you set out.
And who are the key players here? Who's involved in this system?
Right. There are three main roles. First, you've got the grantor.
The business owner.
Yeah, the owner who sets up the trust, puts assets into it. They're kind of the architect.
Got it, architect.
Then there's the trustee. That could be a person, maybe a company. Their job is managing the assets.
According to the architect's plan.
Exactly. Following the instructions in the trust document. And finally, the beneficiaries.
The ones who get the stuff eventually.
Right. Individuals, or maybe even specific parts of the business, who are set to receive the assets from the trust.
Owner sets the plan, trustee executes, beneficiaries benefit. Simple enough. Now, our sources mentioned different types of trusts. What's the main difference we need to focus on for, avoiding taxes?
Okay, yeah. The big one for tax advantage transfers is the difference between revocable and irrevocable trusts.
Revocable means you can change it.
Exactly. Revocable offers flexibility. The grantor can tweak it, even end it. But,
There's always a but.
yeah. But for minimizing or potentially eliminating taxes on transfers, irrevocable trusts are usually the way to go.
Because they're irrevocable. Harder to change.
Pretty much. Once they're set up, the terms are much more fixed. And it's that lack of flexibility, that permanence, that often unlocks the tax benefits. It sort of removes the assets from the owner's direct control tax-wise.
Okay, so you trade flexibility for potential tax perks down the road. Makes sense. Now, the big why. Why go through the complexity of setting up an irrevocable trust? What's the main draw?
The main draw, it's really the potential for significant tax savings. A well-structured, irrevocable trust. It can let business assets move, maybe between divisions, maybe to future owners like family or key staff, with way lower gift or estate taxes, possibly even zero.
The trust acts like a shield against those taxes, unlike just handing assets over directly.
Exactly. That's the core benefit.
Now, I saw mentions of these intentionally defective grantor trusts, IDGTs. Sounds weirdly negative.
It does sound strange, doesn't it? But the defect here isn't a mistake. It's actually a deliberate feature.
Deliberate. How so?
It's designed to use a specific quirk in the tax code. See, with an IDGT, the grantor, the owner who set it up, is still seen as the owner for income tax purposes.
So that they still pay the income tax generated by the assets in the trust.
Correct. But, and here's the clever bit, for estate and gift tax purposes, those same assets inside the IDGT, they're considered outside the grantor's taxable estate.
Whoa, okay, hang on.
So the assets can grow maybe a lot inside the trust.
Tax-free for the beneficiaries from an estate gift tax view.
Right. And the original owner picks up the income tax tab along the way.
That does sound intentionally strategic. A way to let wealth grow for the next generation without that big estate tax hit.
Yeah.
What other tax benefits did our sources highlight?
Another big one is potentially dodging immediate capital gains taxes.
When you put assets into the trust.
Yeah, especially appreciated assets, things that have gone up in value. Instead of selling an asset and paying tax or transferring it directly and maybe triggering tax, putting it in the right trust can defer that. Sometimes avoid it altogether, depending on the setup.
Like if a business has valuable real estate, that's worth way more now.
Exactly. Moving that into a trust could potentially avoid a big upfront tax bill.
And I saw something specific about GRATs, Grantor Retained Annuity Trust, especially for S corporations.
Ah, yes. Grats. They're a specific type of irrevocable trust, particularly handy for passing on ownership in, say, an S corp with minimal gift
How
tax.
does that work?
Okay, so the owner, the grantor, puts shares into the grat, but they keep the right to get fixed payments back and annuity for a set number of years.
Okay, like an income stream.
Right. Now, if the assets in the GRAT, the S corp shares, in this case, grow faster than a specific interest rate set by the IRS,
Which you hope your business does.
you definitely hope it does, then any growth above that rate, that value passes to the beneficiaries, usually the kids or successors, potentially free of gift tax.
So you're betting the business growth beats the IRS benchmark rate.
Essentially, yes. If it works out, the extra value transfers tax-free after the annuity period ends.
That's pretty neat. Okay, let's make this more concrete.
Yeah,
Can you give us a real-world kind of scenario? How might a business use one of these trusts?
sure. Imagine a company owner. They've got a really successful manufacturing division, right? And also a separate distribution arm.
Okay.
Let's say manufacturing has some specialized valuable equipment. And now the distribution side needs that equipment to expand its operations.
Okay, so they want to move it internally.
Right. But just transferring it directly, that might look like a sale, could trigger capital gains tax.
Ah.
However, if the owner first puts that equipment into a properly set up irrevocable trust,
Mm-hmm.
the trust can then make that equipment available to the distribution arm, potentially sidestepping that immediate tax hit. The trust acts as a sort of tax-smart go-between.
Like a pipeline, a
Okay.
tax-efficient pipeline for internal asset moves. That makes a lot of sense. What about succession, passing the whole business on?
Oh, trusts are huge for succession planning, really valuable.
How so?
Well, an owner can set up an irrevocable trust to hold company shares. Then they name their kids, or maybe key managers, as beneficiaries.
And the trust lays out how and when they get the shares.
Exactly, maybe when the owner retires or, passes away. And because it's an irrevocable trust, those shares can potentially be kept out of the owner's taxable estate.
Which avoids that massive estate tax bill that could force a sale.
Precisely. It can be the difference between keeping the business in the family or having to sell it just to pay the taxes. Some sources even talk about dynasty trusts.
Dynasty. Sounds serious.
They are designed to benefit multiple generations, keeping a family business going for the long haul, potentially skipping estate tax at each step.
Wow. So not just moving assets now, but strategically planning the future, minimizing tax hits down the line. What about asset protection? Is that part of the deal too?
It can be a side benefit, yeah. Our main focus is tax, but it's true that in some situations, irrevocable trusts can add a layer of protection.
Yeah.
Depending on the trust type, the jurisdiction, the laws, assets in an irrevocable trust might be shielded from future creditors or lawsuits against the original owner.
Might be.
Yeah, it's complex. Lots of legal details matter. The level of protection isn't guaranteed and varies a lot, but the primary driver we're focusing on today, that's really the tax efficiency.
Got it. Asset protection is maybe a bonus, but the main event is strategic tax planning. Okay, so if someone's listening and thinking about this, are there crucial tax rules they absolutely need to know?
Yes, definitely a couple of things. Our sources mentioned business holdover relief.
Okay, what's that?
Think of it as a rule that lets you transfer certain business assets into a trust without triggering capital gains tax right away. That can be really helpful when setting up these trusts.
So it smooths the initial transfer.
Right. And the other big one is being aware of the current gift and estate tax exemption amounts.
How much you can give away or leave behind tax-free.
Exactly. These amounts can be pretty high right now, but, and this is key, they can change. Congress can change them.
Ah, so you can't assume today's limit will be there tomorrow.
You really can't, which just highlights why planning ahead and reviewing that plan is so important. Don't wait.
Good point. Okay, so for our listener who's thinking, right, this sounds relevant, what are the practical, actionable steps? What should they do now?
Number one, absolutely top priority. Talk to an expert.
A tax advisor, a estate planning lawyer.
Yes, someone qualified who understands your specific business, your goals. They can analyze everything and tell you if a trust makes sense and, critically, how to structure it right. This isn't DIY territory.
Definitely not. What else can they do to prepare for that conversation?
It helps immensely to get organized beforehand. Make a detailed list of your business assets.
Everything. Buildings, equipment.
Everything. Real estate, machinery, cash, intellectual property, company shares, the works. Having that clear picture is vital for planning.
Know what you own. And you mentioned timing.
Yes, timing is crucial. Don't wait until you need to transfer something urgently or until retirement is looming.
Start early.
Start early. The sooner you plan, generally the more options you have, and the bigger the potential tax savings.
Okay. And when they talk to the advisor?
Don't be shy. Ask about specific trust types, dynasty trusts, IDGTs, DRATs, whatever might fit your vision for the business and family.
And keep checking in.
Absolutely. Schedule regular reviews. Laws change, your business changes, your family situation changes. Staying proactive with your advisors is key to making sure the strategy still works.
So wrapping this all up, what's the main takeaway, the key message for business owners from this deep dive?
I think the core message is this. Trusts, especially the irrevocable kind, can be an incredibly powerful tool for strategically moving assets.
Yeah.
Whether that's within the company or passing it on to the next generation, if you set them up right, manage them right, they offer a real chance to cut down, maybe even eliminate, gift and estate taxes. Plus, you get more control over how things happen. It helps preserve the value you've built.
So it's control, potential tax savings through the right structure, and just the huge value of planning ahead. That's really powerful stuff.
It really is. And, it leads to a final thought for you, the listener.
Yeah.
How could thinking strategically about asset transfer, maybe using trusts, actually benefit the long-term future, the financial health of your business, your family? It's definitely a question worth exploring. Talk to a professional, see if this sophisticated tool could be part of your strategy.